Hey, what is up, everyone? Welcome to Market Psychology 101, where we look for value in the markets when there's fear and are cautious when there's greed. Today's video, it's going to be a little different. Usually I show the current technical price action in stocks and crypto, but for today, we're going to do something different. We are going to talk about how to prepare to invest in a recessionary environment. Now, as I showed in the beginning of the video, I'm not a financial advisor and things can always be different. So what I try to do on this channel is play the laws of averages, try to simplify things as much as I can for the casual-minded investor. Again, I'm not promoting trading here, but I seek to find out where are the best value times to put in your hard-earned money so that later it pays off for you down the road. Again, there's no guarantees, but we try to look at that in some simplified ways and ways that you guys can do at home, whether it's through TradingView or other ways as well. Now, there is no substitute for getting your own financial advisor or talking to someone about maybe you have a Roth IRA, a 401k, any of those. So if you do have extra money and you're looking for tips, tricks, I hesitate to call it that because I don't want this to sound like a gimmick on how to look for more value. This is something I've discovered that works for me, and I hope it works for you too. Like I said in the beginning, fear and greed. Like Warren Buffett said, be greedy when others are fearful, be fearful when others are greedy. When we are in fear, that's where I like to look for value in the market, in the stocks I like. Speaking of stocks, when I do invest into anything, stocks or even crypto, I like to do my own research. Make sure it is something I like a lot. That way, if it goes lower in price, then I will love it because it's at a discount. If we are to enter into a recession, like more and more people are saying, we've had the yield curve inversion, unemployment's going up, economic contraction. You've probably heard these terms and buzzwords in the news or on other YouTube videos. I'm going to briefly go over what that means. But if we are to get a recession, we'll talk about some ways to look for good historic values on average. So I want to be clear about one thing. It is impossible to predict if, when, or how much a recession is going to impact any of these stocks we really like. And when it comes to stocks, this is my personal opinion. I only invest in stocks I like and stocks I use because it is the best way to have insider information as far as where to put our money. If, let's say, you have a lot of Apple products and you notice within the next 5 years, their products really start to go downhill. They're not as good or as innovative as they used to be. You have insider info to know that maybe this isn't the best place to be investing your money. So that is one reason I like to put any of my investments in the stocks. I have to like them and I have to use them. With crypto, it's more speculative. We're not going to be getting too much into that today. We also talked about fear and greed. It will show a crypto. Whoa, Temu with the advertisements is as always. You can get a camera, a onesie, that cool safe. But when we go over to fear and greed, typically, this isn't a perfect correlation, but when we've been down in extreme fear, those have been good value times to buy crypto. It's not too different with stocks as well. So we have fear and greed. We have TradingView here, and just right in front of you, by the way, you see these lines on this chart. This is Apple stock. This orange line is the 50 moving average. The light blue line is the 100. The dark blue line is the 200. And when we look at this on different time frames, right now it's on a monthly time frame. If we click the 5-year, it'll put it in weekly intervals. You'll see now instead of the 50-month moving average, it's a 50-week moving average, a 100-month moving average, a 100-week moving average, a 200-week moving average. And on this channel, as I talk about stocks and crypto, we were talking about Apple back here when it was at the 100-week moving average. And I said on here that historically, this happens once maybe every other year, if not less than that. And so even if it goes lower, this isn't a bad time to dollar cost average in if Apple is a stock that you like. You see it happen back here a couple times, 22, 23, back here in 20, back here in 2018, in March, April of 2016, 2013, so on and so forth. Again, we don't know where the bottom is going to be, but when a stock you really like is getting down to those lower moving averages, once things do recover, and there's no guarantee how long that might take, you will be getting better value on your investments. We can even go back to the monthly charts here. And you can see right there, Apple loves that 50-month moving average. Those times were great value times to buy. And even when the sky was falling after the 2000 dot-com bubble, and Apple was as cheap as 33 cents, 27 cents. I know there's probably stock splits that happened since that time. Guys, it's gone up 1, 2, 3 decimal places. So it's gone up 1,000-fold since then. $1,000 in Apple back here would be $1 million today, 21 years later. So that is one way of looking for value right here on these moving averages. Another way to look for value, you can look at this on TradingView. You can also find this on many other sites. If you click the financials, you probably hear people talk about this sometimes, and that's the price to earnings ratio, also known as PE ratio. And I didn't upload any of those historical charts, but I have read and seen that the average for PE is something around 16 or 17 overall. So if the PE ratios on some of your favorite stocks are below 15, 16, those are good value times to buy. But again, I think that's kind of similar to how we are looking here at the moving averages. Okay. Another indicator I use, and I would be zooming way out on the monthly, is there is one called a 1020 MA crossover with Heikin-Ashi signals. There's other ones too, but this gives you these green and red dots for buy and sell signals. All because you get these signals doesn't mean it can't go lower. Look, the monthly buy signal here still went much lower. So any of these indicators, and this goes for TA or technical analysis in general, there is no silver bullet. We have many indicators that can tell a story, and there's always changing variables. So you have to decide for yourself and put your money where your mouth is. Is this a time that you can buy? Is it a good value time? You can see here a lot of these green buy signals going up, but that doesn't mean, again, that it can't go lower. There has been times, look at here, green dot, and it still went much lower. Another thing we can look for, and let's move off of Apple for a second. Let's pull up a different stock. Let's pull up NVIDIA, because I know this is going to be controversial, but I'm going to say it anyway. So NVIDIA, this has been on an historic run ever since the bottom here in 2022. Okay, let's say a recession happens later this year. People might ask, how cheap do you think NVIDIA is going to be? Again, I don't want to get into the game of making predictions. It's a real easy way to look like an idiot, look like a fool. It's usually not going to play out. But what if I told you that stocks like Microsoft, Apple, and other ones that you know and love, the top stocks in the world, have fallen 50+% in some of the worst recessions? Apple, we're going to go back here. We're going to measure out some of these. So let's go from, this was when it bottomed in late 22, 30%. Good correction. Again, these are times where people are freaking out. And if you were to tell people, hey, I'm buying stock, usually during these times, people tell you you're an idiot. Like, why would you buy stocks right now? Things are so bad. Again, here at Market Psychology, I try to preach to you guys, if you like something when it's up here, you need to love it here. It's at a discount. Let's see how much Apple fell here. 34%. All right. Apple likes the 30% corrections. Maybe that's something to watch for. Here, obviously not going to be not 30%. Sometimes the chart kind of tricks your brain. 40+%, 43%. Great financial crisis, post GFC. How much did it fall there? 56%. Okay, and I know this is going to be even worse. 80%. So let's take a look at these two instances. That was the dot-com correction and the GFC correction. 55% and 80%. This is for what is currently the top stock in the world. No other stock is worth more than Apple right now. It is a market cap of 3.44 trillion. Microsoft is 3.27 trillion. Nvidia just a shade under 3. And guys, market cap, by the way, if people are giving you predictions, look at market cap and try to be realistic about it. I hear people saying, well, you know, Nvidia was at 1,000, 1,100, but it did a stock split, so now it is quote unquote cheaper. It is not cheaper. They just divided it 10 ways. If you have a $1,200 stock and they do a 10-to-1 split and they're now worth the $1,200 stock, you're getting 10 of those stocks worth 120. It isn't cheaper at all. The market cap is still the same. So if you're looking for another 10x, that means you believe Nvidia is going to be worth 30 trillion in the near future. And that's not realistic to think about. Let's go back here though. Remember what we talked about with the GFC and the dot-com crash. Where would Nvidia be if we had a 55% correction? Nvidia would be, look at this, you can see it on the right, that moving blue number. A 55% correction, it would be at around $61. If you told people right now that Nvidia is going to $61, let's even zoom in. Let's make sure we're getting this right. Again, I kind of went from the peak there, but let's go from where we are right now, 55%. It would be even lower, 56, let's just say $60. Doesn't really matter. People are going to look at you sideways, whatever that means. $60 Nvidia, you're crazy. And that's around the 100-week moving average. We've been experiencing great times for a while. And again, guys, I'm not saying a recession is going to happen tomorrow, next year, the year after. Who knows? But if it does, and these things can take a while to play out, I'll show you that on the charts again. If it does, then these might be the prices you see a year or two down the road. What if Nvidia corrected 80%? Where would that put us? 80%? That's impossible. $25. Can you imagine Nvidia at $25? Now, comparing percentages isn't, in my opinion, a great way to look at it, just purely based off that. We have these moving averages. We also have price action back here. Look at all this price action we had back there. That'd probably be near the 200-week. That would be, whoop, we have to do it the other way. My mistake. Let's compare it to all this price action down here. A 63% drop, somewhere around $45. Could that happen? $50 Nvidia? If we get a bad recession like the dot-com bubble or great financial crisis, sure it could. We'll take a look at the S&P here. Let's go back in time to the great financial crisis and the dot-com bubble. By the way, guys, these red vertical lines here, this is when the Fed cut rates. Maybe you've heard about the yield curve inversion. Like, what the heck is the yield curve inversion? You have to take it off log scale. When inflation was running hot, the Fed raised rates higher for longer. That inverted the yield curve. It changes the price of U.S. government bonds. That's why the yield curve is the U.S. 10-year minus the 2-year. It inverted the curve. When they cut rates, that's typically within a couple months of the uninversion. Let's take a look at these dates here of when it uninverted. January of 01, that's the dot-com bubble. May of 07. We'll go back here. This is when they cut rates, by the way, that red line. This red line, where is it? November of 2000. That's, you can see it at the bottom there. November of 2000. That's within a couple months of January 1. And then here, remember we talked about July of 07? Or maybe it's August, I forget already. The yield curve inverts with rate cuts. These red lines are rate cuts. So when you hear rate cuts, and I've already seen comments on this video, rate cuts are a good thing. Well, down the line, yes, but within the next couple of years, be careful. Now, I know things are different this time. We have inflation to deal with. We'll talk about that in a bit. But look at here, from the rate cut to the bottom, that was about, or the last peak, 820 days. Maybe you're going to call this the bottom, because it was 680 days. Okay? From the peak to the bottom. Again, we had like a 50% correction from the peak to the bottom, 760 days, 50% down. Okay, these take a couple years or a year or so to play out. From the rate cut to the bottom, I mean, this was over 60%, I believe. That took 581 days, a year and a half. So when the Fed cuts rates, be careful. And I don't think it's a one-to-one comparison or as good of a comparison anymore. But this was the 70s and early 80s. This is when we had 3 spikes of inflation. Each spike of inflation, a cross-reference with the white vertical line. Each red line was a rate cut. So the Fed was pretty good about cutting rates kind of near the bottom was when the economy was already struggling, but it was already on its way down. So we'll see what's going to happen. Every time is different, but I want you guys to be careful of this narrative that rate cuts are going to make things go ballistic. You can see rate cuts, things went down. Rate cuts, things went down. The Fed's doing this because the economy's hurting. They're not doing this to be nice and make us all rich. Rate cut, we went lower. Rate cut, near the bottom, went up. Another rate cut, or rate cut. These are rate cuts after holding higher for longer. So rate cuts, things went down. Okay, here, rate cuts after higher for longer, things went up. And then there's the 87 crash. Here are rate cuts, but the market still went up. So do take these occurrences with a grain of salt. One thing that has me cautious is this yield curve inversion. How long it's been inverted. Typically, the longer the inversion, the worse the recession. But we'll see. We don't know what's going to happen this time. So those are some indicators to watch for. We also have the unemployment rate. Let's cross-reference some dates here. So unemployment spiking. You can see the dates at the bottom. Great financial crisis. Unemployment spiking. That was the dot-com bubble. So when unemployment gets to around 6 or higher, things will probably be pretty discounted in the market. The VIX. This is the volatility index of the market. Right now we have low volatility. We have an election coming up in 3 to 4 months. If anything, things are probably going to get more volatile. And in the last 20 years, usually the market has been more volatile and had more corrections later in the year, August or October. But if you just watch the volatility, and let's say you're taking a dollar cost average approach and you're DCAing in when we're 25 or higher, you're getting pretty close to the bottoms again. This is COVID times. This is great financial crisis times. Look at that volatility. People would be calling you an idiot for investing back then. When if you did invest in Apple or Microsoft or Google, you would have huge gains. Amazon, any of these. So here at Market Psychology, again, you need to turn off your emotions and have a plan. And the reason why I tell you guys to make a plan is because when we do get into these emotional times, and these times are tough, they're emotional because people you know, friends, family, they're going to be impacted. They're going to lose their jobs. It's not a time to just celebrate and say, yay, I can get stocks for cheap. These are not fun times. And yet we can still take advantage of those times with respect to people that do go through difficult economic situations during that time. These times do suck for people that we personally know. When we're thinking about investing and getting lifelong generational wealth, we have to be smart and look for value in these times. We have to be forward thinking. I heard, I don't know what sports you guys watch, but I heard An analyst talk about this with a football player who was signed to all this money, and then to another one that this team let go. I'm not even going to tell you the team because it's besides the point, but the guy said, you're not paying a player for what they have done. You're paying them for what you believe they're going to do. And so you have to be forward thinking in your investment strategy. Is NVIDIA, if you're thinking of NVIDIA, let's say NVIDIA does get down to somewhere like $50, like we said, 45, $50. It has a huge correction, hits the 200-week moving average, corrects by 60+%. It's around $44. If you're investing in NVIDIA, you're not investing for how good of a company it has been. You need to do enough research to believe it is going to be and continue to be a great company. Again, I'm going to go back to an earlier point I made. Is this a stock with a product that you like and a product you use? Ways to look at the financials of a stock. We can go here, and this is Market Watch. There's other sites you can do this at too. But taking a look at a stock's balance sheet. For Market Watch, you can go to financials. We're only going to do this for NVIDIA. Financials and then balance sheet. A couple quick little things you can look for. Where are their assets trending? Are their assets trending up? That's a good thing. Okay, $44 billion in assets, total assets, not current, 65, trending up. Both good things. Liabilities, $10 billion, trending up, but still far, far less. Total liabilities, 22. If you take the total, that's about a 3-to-1 ratio. If you take a current assets to liabilities, we have 10 compared to 40, 4-to-1. A 4-to-1 or a 3-to-1 ratio is great. This simple way of looking at a balance sheet, where's the stock's ratio? Is it above 1? A lot of these exciting stocks, these speculative stocks, the ratio is underneath 1. Their liabilities are greater than their assets. You want to be careful of those before a recession, because should a recession hit, those companies get hit harder, and it is tougher for them to survive. So an essential question I have for any stock I put my money into, do I believe it's going to be around in 10, 20, 30 years? NVIDIA, AI chip maker of the future? I think so. You never know. I mean, what if NVIDIA pulls a Cisco of 2000? Everyone was high on Cisco in the dot-com bubble. If you told people Cisco would have the correction it ended up having, they would have said you're crazy. Now, I'm not saying this to pour FUD or water on the NVIDIA flames, but to prove to you guys, we don't know what's going to happen. This was the NVIDIA of the dot-com bubble. Look at that. It corrected 86%. Can you imagine? Got down to $10 all the way from 70. And when did it get back above 70? God, it took a while. It still hasn't. Look at this. You can see the lines going all the way over. It has still not gotten past the dot-com bubble. Got close. So might that be the future for NVIDIA? I don't think so, but you never know. Again, you have to do your own research. Is it a stock you like? Is it a stock you use? Microsoft, Apple, I believe, obviously these have been two of the best stocks the last 20 years. I think it's very safe to assume, them, Amazon, NVIDIA, Google, that they're going to be around in 10, 20 years. What about Meta? This is they're trying to get into the virtual reality world. Stock's doing great. It's one of the Mag 7 stocks, the AI 5. Guess you could put it in there. But it's a social media platform. How great, or how much use is this stock going to have in 10, 20 years? I don't feel like that's as predictable. Google, I would feel safer with. This is just me externally processing to you guys, thinking out loud. Starbucks. People love their coffee. I think Starbucks, this is my opinion, probably famous last words, but I believe Starbucks probably going to be around in 10 years People will still be drinking coffee, unless things go horribly wrong as far as how it's run as a business. But that's, if I am to believe that and then put money into it, I have to back it up and do research. I have to research the pros and the cons. Going along with making a plan, do some research, look at the balance sheet, write down the 3 biggest pros, the 3 biggest cons. Try to be objective, remove your emotion about it. What if Starbucks is a stock that I really like, or a product I really like? It's one I use. I get it. Starbucks coffee every week. I don't. I'm just making this example, though, to get you guys thinking a certain way. Well, now I'm going to research pros and cons about this stock. Okay. Right now, great value. Okay. This is one way to look at great value. Historically speaking, Starbucks at the 100-month moving average. It's only been under there once in the last 15 years. Great financial crisis got down to the 200-month moving average, $6. If you would have bought $1,000 worth of Starbucks back here at $6, you would have 12x'd your money. You'd have $12,000 today. And at its peak, if you bought it at $6, at its peak is at around 120. You would have 20x your money, 20,000 from $1,000. Another thing, and maybe this will be the last thing we talk about in this video, I wanted to talk to you guys about, and that is, what stocks typically do better during recessionary times. Because as you can see here on this chart, all stocks suffer. Doesn't matter if they're the best one. But I want you guys to make yourselves familiar with this term. That is ROIC. ROIC, return on investment capital. You can search up what are some of the top ROIC stocks. And as you can see, over time, just compared to, the general movement of the stock market, ROIC stocks tend to outperform the S&P and just your stocks on average. So you can research what are some high ROIC stocks. Pulled up this website before just to show you guys a list. Again, all because I'm showing you a list of ROIC stocks doesn't mean these will continue to be great stocks. Again, my personal opinion, you look at this list and you can see here, ROIC. Are there any stocks you really like on this list? Any you use? Okay. Write down those names and then start researching positives and negatives. And again, if you're going to pay one of these stocks, like a pro team is going to pay a player, if you're going to pay a lot of money at one of these stocks, you're not paying the stock for what it has done. You're paying the stock for what it's going to do. You're paying this stock to do better in the future. And you want this stock to pay you to own it. You can look at dividends or how well it does, stock buybacks, all those sorts of factors. We can go deep down this rabbit hole. I want to keep this video to 30 minutes. I want to button it up here. Dropbox. Look at that ROIC. Okay? But again, I don't invest in Dropbox. I would have to do a lot of research. Potbelly, I've had their sandwiches. They're good. I don't know if they're doing well at expanding or not. NVIDIA, everyone's darling stock right now. Domino's Pizza. Do you order Domino's? Do you like Domino's enough to buy this stock? Okay, and again, do you like it forward moving? Chipotle, man, they just had one of the largest stock splits ever. This has been a great stock. I don't own any. Zoom has fallen through the floor since COVID. Might this have great potential down the road? Starbucks, some others. Maybe there are some on this list you're looking at. You're like, hey, I know that stock. Write it down. Write down a list of, maybe look for up to 10 stocks of products you like, that you use. Maybe it's for a company that you work for or contract with. There are many ways to look at this, okay? And I'm not saying don't buy stocks that, you don't use or don't like, bank stocks, things of that sort. I see IRAs, 401ks kind of dabble more into that. So when I invest on my own, I'm looking for other things that my IRA or 403B, whatever, 401k, whatever you guys have, I'm trying to look for other things that maybe they aren't looking at. So to recap, how to prepare for a recession. Again, there is no promise of if, when, how much we are going to experience a recession. Is the S&P 500, is it going to fall 20% like it did here in 2022, 20 plus 20-ish percent? Or is it going to fall 50% like it did in dot-com great financial crisis? I don't know. If it's going to happen, I don't know how quick it's going to happen. Whether it's going to be like the COVID crash or the 1987 flash crash, I don't know. But these are ways to prepare. You can look at PE ratios, moving averages. Again, that is my goal on this channel, guys. For any of you new subscribers to this channel, how can we look for more value on your investments? You are paying these stocks not for what they have done, but what they are going to do. And you are paying these stocks to pay you. Think about that. You want these stocks to pay you to own them. You want that investment to work to your benefit, whether it's through dividends, growth, whatever. So look at the ROIC stocks. Eye up the moving averages. Again, this is, in my opinion, it's one of the most simple ways to look at it. We can start out, I like to start out with the biggest time frames. Microsoft. How often is that the 50 moving average, the 50 month? Once, twice, 3, 4 times within the last 15 years. Okay? That's not often. So when it's there, probably a good time to dollar cost average in extra into Microsoft. Not financial advice. How about the weekly? Maybe, you want a dollar cost average in more often. Okay? You can look at the 50. Maybe you're going to dollar cost average in every month, but if it gets to the 50 or underneath, you're going to put in more. These are ways that you have to approach these stocks. But guys, check this out. This is dot-com bubble. Microsoft came down to $25. It was there for a decade. So if Microsoft were to fall, like it did after the dot-com bubble, if Microsoft were to fall 50, 60%, are you prepared to put into a stock for a decade until you see those benefits? I mean, Microsoft right now is at 440, but if you spent a decade buying Microsoft stock at an average of $25, you've 20x your money. Over the course of 10 years, even back at this time, inflation notwithstanding, I find it hard to believe within 10 years you could not get 100K into this stock. And by now, 15 years later, that 100K would have gone up almost 20x. That 100,000 would be worth 2 million. So some things to think about, some things to consider. If you like a stock up here, you need to love it here. And do you love it enough to stick around with it through the good times, the bad? How defeating would that have been? What if this happens with NVIDIA? You really like NVIDIA, fall 60%, you're like, hell yeah, I'm investing in NVIDIA. And then it starts to run up and then it crashes 8 years later. I know that's going to piss off most people and shake them out, be like, why the hell am I investing in this? Next time it goes up, I'm going to sell. You sell, you break even, you wasted all that time, and then 10 years later, you're like, God damn it. So make a plan. And, if you do make a plan, you have to, again, be able to remove the emotion so you stick to that plan even when things get bad. Because, if someone didn't stick to their plan at Microsoft, man, they would have missed out on a 20x after accumulating for 10 years. So guys, again, I hope you enjoyed this video. If you have any personal tips, tricks, simple things you look at for investing in the long term, finding great value, more than what I just showed you today, because we can get more into the weeds, and I don't want to do that for this channel, because again, I don't think that's going to hold most people's attention. And no, I'm not trying to just do this for views. I don't get paid to do this at all. But I also see the reality of how short people's attention spans are. And we want to start simple before we get deeper into the weeds, talk about other investing philosophies and metrics, things that get way too complicated. I want to show some of the most simple, easy ways to look at it and consider it. And again, there's no guarantee in any of this. So now's the time to make a plan. I don't know if a recession's coming later this year, next year, the year after, 4 years from now. Usually it's once a decade, okay? But now it's the time to make that plan, because let's say if a recession, like a 50% recession, comes next year, you'll be ready to execute that plan no matter how emotional times get. We don't know what's going to be happening globally. Wars, layoffs, family, friends losing their jobs, awful things. If you're married and you or your partner lose your job, it's going to be very hard to think about investing. And I just showed you guys how that's, the best time to invest. Stocks you like, stocks you use, longer time frame moving averages, return on investment capital stocks. Showed you some indicators to watch, such as the yield curve inversion, rate cuts, unemployment. We don't need to make it more complicated than that for now. Hope you guys enjoyed this video. Hope you're all doing well, enjoying your summer. I like talking about this stuff. I hope you guys are enjoying watching this. Again, please write a comment below if there aren't any other things you do, generally speaking, to quickly look at a stock, that you dollar cost average into, where you're watching to get more value outside of what I just showed you here today. Hope to grow a community to help us all learn from each other, because, man, finances, investing, it could be a toxic it could be a toxic space. Everyone's got their ideas and it gets pretty heated. And again, nothing here is financial advice. Promise, best intentions, not trying to steer any of you guys wrong. And I don't claim to know if or when anything's going to go wherever. So anyways, starting to repeat myself. Thank you guys for watching. Take care.